Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets. Kansas City wheat. Once again, it is no longer a surprise to me to see last week, and I suppose this week now, prices hitting and sometimes utilizing the bright red trend line formed of the neckline of the small but influential October 2021 to January 2022 head and shoulders top, currently at 852. I have said repeatedly in my commentaries, this market has occasionally staged rallies up to the 50% Fibonacci line of the August 2020 to May 2021 move at 900, and then these rallies have stalled, and the market has instead turned and expanded the downside. As a result of the declines back in April, they constructed a monthly key reversal down and very nearly did the same for the month of May, but instead chose to make it a lesser outside month instead. These moves down and then back up apparently created a diamond pattern, highlighted in bright green on my daily chart, for the action from April, May and the first part of June. I repeat my comments on this diamond pattern for a 7th week now. You see, I am really not happy about this pattern type, but for the moment it seems it might be useful. The reason why it's especially outlined is that 6 weeks ago the market broke up and out of this diamond pattern type, thus indicating an initial primary target X for the move in the 902 area, just over the 50% Fibonacci line. And that's for the August 2020 to May 2021 move, and with a further harder to reach secondary target X1 up in the 946 level. Earlier this week, prices finally reached the primary target at target X at 902 before pulling back down. Now, we had a lot of resistances in the way before 900, and that explains why prices started to stutter up there back in mid-June and again last week. However, in the end, the primary target triumphed. One of these resistances, now supports you already know about, is the red neckline. We also have the 2014 high at 856, the 2014 high at 862, and especially the following three that really managed to erode the bullish incentive. They were the slowly dipping long moving average, which has been notable today, and that's currently at 856. The 50% Fibonacci line of September 2019 to May 2022 move at 881. This one had been especially effective last week, and obviously also we have the 900 area, where we have the 50% Fibonacci line of the August 2020 to May 2021 move. These all work together in varying degrees to halt earlier rises, creating a horn top in mid-June, but failed to hold prices down, it seems, this week. Now, looking at this week's action, it also brings to mind what happened in Chicago wheat this week. That is, the market formed a 3-day bearish evening star pattern. This pattern is not correct here. It is a little more refined in that it is a 3-day bearish evening doji star pattern. The doji is important here. As a consequence, anything further should be seen in the light of this 3-day pattern. This goes a long way to tempering another much larger pattern which I saw last week and I wish to discuss today. This is a really big inverted roof pattern, sometimes called a half diamond pattern, formed from the start of this year up to date. Indeed, it could stretch the origination of this pattern to start from November last year to date. However, I'm being conservative in its construction when I say just this year. You can see it outlined in purple on my daily chart. The lower trend line for this pattern is currently at 807. It's a little way below, but the top side capping flat trend line is not. It is the same 50% Fibonacci line of the August 20 to 2021 move at 900. This is the level to watch on any move higher. So how does this week's bullish action over 900 fit in this scenario? Well, given the action was a 3-day bearish pattern, I'm prepared to look at it as a possible false break higher. It does not stop the market from trying higher again, but given we have had one false break, it might be worth considering any further attempts higher with a great deal of care. Minneapolis wheat. Now, compared to Chicago wheat and Kansas City wheat, Minneapolis wheat here continues to be a somewhat easier read with respect to what is going on and what the opportunities might be. In late February and especially at the start of April, we had the first piece of bearish pressure coming from how the medium moving average, currently at 848, capped the market with a subsequent move lower. At this time, the market constructed a large bear channel that after a period of time morphed into what we have seen now, a descending, expanding wedge pattern, currently 702 up to 859, originating from December last year, but really becoming evident from February this year. This is highlighted in dark blue on my daily chart. The upper trend line had been previously reinforced, well, sort of, by the declining medium moving average, which combined to help cap the market in very early April, then mid-April, mid-May, and mid to late June. This resulted in the horn top back in mid-late June. However, by last week, the attempts higher resulted in a clear break above the upper trend line, and also the important declining long moving average. We even saw the market last Friday utilize the long moving average as a base for the latest attempt higher, all the way up to reach the 50% Fibonacci line of the significant August 20 to May 2022 move at 955. With all these actions, last week I was able to place some potential targets for the descending expanding wedge pattern on the upside. Thus, a primary target X is in the 997 area, whilst the secondary harder to reach target X1 for this pattern is in the 1024 area. These are still quite a way away, but they are there. Now, I also raised a potential pattern 4 weeks ago, and I would like to address this now. It was to look at the whole action since February as a possible reverse head and shoulders pattern. I have marked the likely spots for the two shoulders and the head, and though it is sloped and not a perfect pattern by any means, it still has merit, especially when we take the upper trend line of descending expanding wedge pattern as the neckline. Thus, potential targets for this reverse head and shoulders bottom is a primary target X2 in the 954 area, and a secondary harder to reach target X3 up in the 991 area. On Tuesday this week, prices reached target X2 at 954 before immediately dropping back down. This is somewhat satisfying to me, but we still have target X3 up in the 991 area. This also brings me to another point, and is to look at the action over the first 3 days of this week as a potential bearish evening star pattern, or bearish evening doji star pattern. My thoughts on this pattern here are mixed, because I know we had such patterns in Chicago and Kansas City wheat. It's easy to see the attempt being made here. However, I am not wholly happy with labeling such a pattern here compared to the others. So whilst I recognize it, I am not happy labeling it as such, not yet. However, I am happy in drawing a late May to early July bullish Andrews picture, which you can see highlighted in purple on my daily chart. In some ways, this is a speculatively drawn pattern, so I would take it with a pinch of salt, though I have to say it does look good as the market sits in between the middle time above, currently 933, and the lower time below, currently at 875. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.